Good morning and welcome to our FY23 results presentation. We were just waiting a couple of moments. We've got a list of attendees and we've now got a great group of people that have joined us. I hope everyone's having a great morning if you're in Sydney or our international friends from wherever you are. We've got a short presentation. In the past, we've had feedback that our presentations were very long. We've tried to give all of the information in the pack. And today what we plan to do is go through that short presentation and then take questions. I hope everyone's had a chance to review the information. We think that the most interesting thing about our group is that we have a system that has been able to demonstrate over nearly 20 years that it can double the business generally every 3.2 years on average. We were told almost consistently as we grew the business that it become harder to grow the business, that we would have to do larger transactions, and that that might prove challenging. What we found is that with a programmatic acquisition approach, that we can continually grow the business, and we believe that it is now obvious that it's becoming easier to grow and more predictable, certainly not harder. And so we always try to present our results in the context of a long-running, consistent way of doing business. And I think that is hopefully at this point quite easy to understand. Many times we've had people say, "Hey, Brett, can you tell us about the company in 10 seconds or less?" As we've met with investors over the years. So we invented this little screen, KPG in 10 seconds. It looks at the profit and loss, balance sheet and cash flow, simple metrics that I think are easy to understand. And it shows clearly the progress of the business. Revenue has grown very strongly again this year. We've done more partnerships than we have in any previous year. And we've grown the revenue very strongly and locked in strong revenue growth for next year. We expect that with 33% revenue growth this year and a locked in 30% for next year, we've grown the revenue about 60% over the last 12 months, which has been a huge effort from the team, and certainly appreciate everyone's efforts. You'll notice that the revenue per FTE is still very strong, and we're pleased with the progress of the business at a revenue level. The EBITDA margin is tight and isn't where we would like it to be. However, in the context of a much larger group of businesses joining the group, it is, I think, understandable and expected that it just takes a little longer to get those businesses all tidied up together. And that's proceeding very, very well. We've budgeted for this year and we're trading into this year knowing that margins will return to their historical averages. Parent NPAT-A is down as we've made large additional investments above the 9% that we collect from the firms. But that pattern of additional investment, I think, should be well understood now and has proven to be a great use of the capital of the business. It's sacrificing short-term profits for long-term value, but not very long-term, as it'll be very obvious by 31 December that there's a real return on that investment. Return on equity remains very strong. It's fallen slightly, but I think at 38.4% and a ROIC of 20%, I think there's still very strong returns. The gearing of the group remains very moderate. We're at 1.65 times net debt to underlying group EBITDA, and you'll note that the lockup days are industry leading at 48 days. Cash flow is very strong. Operating cash flows up strongly, and the cash conversion is very, very strong. So the underlying cash flow position of the business is terrific. In terms of capital allocation, this little scoreboard we've provided for some time now, I think is worth looking at. We're trying to improve the earning power of our operating businesses. I'm I understand the compression in that margin in this period, but know that that won't continue. With number two, we try to increase the earnings through acquisitions. We've had, very strong years, 2 years in a row, and locked in a strong year for next year, which we're really pleased about. We think that the business is materially different at 105 to 110 million revenue than it is at 45, and that's really a couple of year turnaround or growth. Growing our existing subsidiaries, growing complementary businesses are growing strongly, continuing to increase the cadence of our programmatic acquisitions, staying away from transformational acquisitions. One this year, which is a large acquisition but not transformational, and repurchasing KPG shares when our cash flows arise. We really believe that the additional investment we've made in the future growth of the business is better than alternate uses of that capital, such as repurchasing our shares, notwithstanding that we think the shares are deeply discounted to intrinsic value. Our ROIC is averaging, the way we think about this measure, at about 30%, which is our ROIC plus organic revenue growth. We've always targeted 5% organic revenue growth. In years where inflation is 6%, that doesn't look as good as it might, but I think it still proves the long-term thesis of what we're trying to do. We've provided a strong information here around how we run our additional investments. In FY20, we invested 1.6 million above the 9% we collected, which was 3.6% of revenue. This year's 2.4 is only 2.9% of revenue. We expect that will lead to an almost doubling of earnings. And the pattern, I think, is worth understanding, is that 1.63 went to 371, we went to 77, it's gone back to 2.49, and you'll see that number drop again strongly. We think buying firms, when good firms present themselves, we're going to resource the group and make sure that we can do a great job of the integration, notwithstanding the short-term impact on earnings. So our final sort of upfront slide looks at our programmatic acquisition approach. I've been asked many times over the last 5 years, "Hey Brett, listing the company, do you think that's made sense? What are the pressures of running a listed company as opposed to a private company?" And there's a few things to consider here, but in particular, we've got a nearly 4-time increase in the number of firms that we've been able to have join the group in the 5 years that we've been listed, as opposed to the 5 years pre-being listed. And I think that proves out the thesis of making ourselves more visible and making ourselves a more credible counterparty to leading firms, to men and women that have spent much of their life building a firm that they really care about, a business that has really absorbed a lot of their time and heart and soul, and who are looking for a trusted counterparty to take that business forward with their, in a respectful way with their partners and their clients and their in their local communities. So I think that is proving to be the right way to play, although different. And look, most people are looking for differentiation, but are uncomfortable with difference. We know that we can't differentiate the business other than by being different. And on the other side, we provided a look at the way that we are running and have run our acquisition funnel for many years. So there's 28,000 firms that we are contacting consistently across the US, the UK, and Australia. There's 138 live leads. We are actively meeting with firms. We expect that we can very materially grow the group over a virtually unlimited runway. Unless governments decide that they are disinterested in taxing people in the future, we expect that we can continue to grow a business that works with private business owners to manage their tax, accounting, and multi-generational, essentially family office affairs. So, I couldn't be more pleased, frankly, with the improvements we've made in our system around programmatic acquisitions. For the first time, we've got a person working full-time on that. We've invested in technology, and we're running, I think, now an even more professional version of what we've done before, which is really, I must say, tremendously excited. I also wanted to share that we will appoint an investment bank to undertake a strategic review. We consider that the market cap of the business is materially different to the intrinsic value. And so we'll sign an engagement letter later today to undertake a strategic review to try and work out how to maximize the value of the group for all shareholders. We really think that the business has a way of understanding how to acquire, integrate, and improve accounting firms that is unique to the global market, and certainly the interest from many, many groups approaching us, not just firms, but private equity, private capital providers, and other excellent quality shareholders, long-term investors. I think there's a growing understanding that that's the case. I think it's incumbent on us as management to find the best way to maximize the value of the know-how of the group for the benefit of shareholders. And so we're investigating what is the best way to do that. We are and remain committed to our current plans and maximizing the business opportunity over the long term. There is no change in terms of how we're doing what we're doing. But we are, in fairness, having been approached by a number of groups, wanting to get the right advice so that the board and the business can be really advised in a world-class fashion. That's pretty exciting because it's just showing us interesting and different ways to think about the business, and looking at comps of the business performance versus global peers, is quite revealing. In the digital space, we've built a single point of truth that sits over the top of the systems across the group. We're trying to structure the data that we have. We have nearly 20,000 private business owner groups now as clients. They're 90%, more than probably 93% on one system, 7%, 6% on one system, no percent on one other system. That gives us an opportunity to have all the data basically in one database, structure that data, and be able to provide views of that data to our client directors and the clients. That's different than what can happen in other firms, to give us insights for the clients and our directors. That's different than they would otherwise be able to access, which will mean that we can more consistently put our differentiated client offer to the clients, which is incredibly exciting. We've made now good progress on that project. Yesterday, our app called the Kelly Partners Passport, which is your gateway to added values from Kelly Partners. So we'll give clients a way to get full value from their Kelly Partners relationship and the relationships of the group. Has been approved by Apple's App Store yesterday, which is great. We've still got quite a lot of work to do to get it to where we would consider it really world-class and world-beating, but there's a lot of progress being made in that respect. We've now got nearly 20 people working in our Indian office, with 10 more to come. We're making good progress on our investigations and opportunities in the US, and we're undertaking with a search group a thorough investigation of the UK market. And so we feel in between where we've been and where we'd like to be, but very, very excited about what the opportunities are, and seriously and working seriously hard to work out the best way forward that keeps us within our circle of competence, that ensures that we take on no material risk to the group, and allows us, on the basis of a long march, to prosecute the investment thesis that we commenced the group with and have remained relentlessly focused on for a very long time. I'd like to finish the first part of this presentation by just stressing that when I started the group in 2006, I believed that the incumbent players in our industry had a fatal flaw, and that was that they didn't have the depth of mission, values, and vision aligned to good ideas that they would need to prosecute their position for the next 100 years, notwithstanding that they were 150-year-old businesses. Without putting anyone down or casting, aspersions as to other people and their behaviour, there's enough press today to make clear that those businesses that a moment ago looked shiny and untouchable are not as strong as they could might otherwise have been perceived. We consider those firms incumbents, the big four in the second tier. And we do believe that a new style of organisation with a different mission, with different values and a different vision has a genuine opportunity over the next 25 years to build a very significant market position. And so if you look at the book, Founder's Mentality, it was written by Bain. It's a book that is very close to our heart. It talks about making sure that as an insurgent business, you don't allow people to drag you over to the mission, values, and behaviour, if they have any, of the incumbents in your industry. So we are determinedly different. We are determined to continue prosecuting that position as an insurgent. And we believe that we are starting to accrue the more obvious benefits of that approach. It's taken nearly 20 years. We expect it'll take another 30 years to get the group to be anywhere near what we think is a flourishing of that full vision. But we hope that there's enough green shoots there that our quality shareholders can understand the seriousness with which we're undertaking that process. Now, in the back of that, I'd like to call out Ken and his team have done a great job in getting these financials together and getting them out to the market swiftly, which is terrific. As always, we could have released on the 1st of August, but we had other commitments, so we just pushed it back. We've had the numbers ready for some time, and their team has worked extremely hard to make that happen. I'm going to leave the rest of the information to be reviewed in your own time, and hopefully since 8 this morning when it was released, people have had a little bit of time to consider what we've presented. And now we would love to take some questions. Now, various people have emailed me questions over the last week, and I've refrained from answering those questions because it was so close to release date. But I know a number of you are on this call, and so if you do have questions, pop them in the chat, and we'll get busy now. We've got time to take questions and give people some answers. I can start, I think, with the first question that I can see, which is, hello, Brett, can you tell us more about the India office? What's the purpose of setting up an office in India? So what we came to the view that we'd seen the days to recruit go from 20 days in our group to 24 days, 25 days. However, we've only got 6 open roles in the group at the moment. And what we see is that if your workforce are interested in working remotely, then really it doesn't matter whether they work from 3 suburbs away or from the other side of the world. Often we would get first-generation Australians from various parts of Asia, South Asia, England, Ireland, wherever they come from, come to Australia and work in the group. Those same people with the same qualifications and experience can happily work from anywhere. We believe that building a global business will require a global workforce. And so we want to build the muscle to be able to work with people at distance. And so we've taken a very conservative first step under the guide, or in partnership with Eisner-Amper, a large US-based firm, to help us build out a facility that can hold 60 people. Year lease, WeWork style leasing arrangement, and start to get our firms to put some team members in there and learn how to lead and manage people at a distance. The great news is that I think we could run 10% more people over the last 5 years than we've been able to access in the market as part of our team. And so we think that these team members can supplement our local teams. Hopefully that makes some sense. Second question, will you be overseeing expansion in the US? I am splitting my time between Australia and the US. I conducted investigations with a number of Australian firms that have moved their listing from Australia to the US, and other firms, Australian firms that are doing business in the US, of which there are a lot. I met with a US consul in LA who mentioned to me there are 60,000 Australian businesses in Los Angeles, and there's not a single Australian accounting firm. So that looks like an opportunity. But I've got my feet on the ground. I've got my AI CPA. I'm doing my Californian CPA. We are building tremendous relationships. We've signed our first binding term sheet that we're now negotiating the long forms, and we're learning a ton about that market. The market looks a lot more like Australia than you'd suspect. Frankly, it looks like a land of opportunity. There's 12,500 firms in California. The market appears, without giving the hard-earned proprietary insight of the group away, let me just gently say that we're confident that there's an opportunity for us to find a single firm, do a good job of it, and grow a business and an offer to our people and our clients that's very unique and very different, and I think will ultimately prove to be very valuable. There's another question there. Also, have firms who joined Kelly Partners prior to 2019 substantially paid down their debt? Yes. We, in a very disciplined fashion, buy the firms and we pay down their debt every month. They're paid on a fixed payment schedule. So we basically set up the repayments to be a 4-year period or a 5-year period, depending on the projections. And then every Monday, those businesses are debited and they pay the debt down. And there's not been any slippage that I am aware of in any of those firms paying their debt down. You'll be able to see that I think we increased our borrowings this year by 11 million, while we paid down over $9 million of principal repayments. So we have always very disciplinedly simply acquired an asset, geared that asset and paid it down. We don't seek to draw profits from those businesses until their debt's paid down. Hi, Brett, what exactly does KPG do? Getting acquiring margins up to the group standard. Well, Matthew, we can tell you what we do. We've got a very highly developed, over nearly 85 of these transactions, big, small, and in between. We take the P&L of the existing business. We take a P&L that's got very detailed and proprietary insights around what every single expense line should be in one of these firms. And the benefit of doing the same type of transaction over and over again is we've developed real insight into how these businesses can run if they're run well. And we simply work ahead of the transaction if we have, if we're given the opportunity and the time, and certainly immediately once the transaction closes, to change the margins, which is really, really exciting. Takes a little bit of time. If we do 1 or 2 or 3 deals, we can do that very quickly. If we do a few more, it takes a little bit longer. We are trying to coach the firms to do more of that themselves now under our tutelage, rather than being, going in and just doing it ourselves. That's working well. It gives you a partnership that have more owner mentality and more understand what you're doing and how you've done it, which I think in the long term is a better partnership. But that's what we do. Works very well. Could you talk more to the strategic review and in particular rationale behind a potential privatisation, how that could potentially be done? It's a great question. I wouldn't be doing my job in terms of acting in the interests of all shareholders to let the business continue to trade at a share price that doesn't reflect the intrinsic value of the group. It takes away the opportunity that we should and could have if the market cap better reflected the strength of the business. There are places around the world where if this business was listed in a different market, the business would naturally trade at a much stronger valuation and would attract the attention and involvement of investors who can play in those markets. Australia is a harder place to invest for many global investors who have said that to me continually for 5 years. That said, I've always said that, traditionally this business would be private, so it'd be really hard to invest in. But there it is. So we want to look at, we have been approached by a SPAC out of the US. We've been approached about a potential take private. We've been approached proposing private equity partnerships. We don't have a fixed view of any of those opportunities, but we just believe that we needed we need professional assistance to help the board consider the best steps to move forward. And so you'll hear more about that imminently, but we will appoint an investment bank later today when we get a chance to sign the engagement letter. We're a little bit busy. Don't fret that there are no significant costs involved in that. There are, in fact, no costs involved in that unless a transaction emanates out of that review. Another question, can you please elaborate on various of the ideas under consideration, namely listing US, discontinuing dividend, or delisting or going private? I understand all these still under consideration. I'll just take them one at a time. If the business was listed in the US, the business would be materially more valuable, is the information that has been put to us, and it would also open up the same opportunity that has occurred in Australia, where we would be more visible, considered more credible, and likely to be a very good alternative to the very active private equity involvement in our industry in the US at the moment. So, the thesis when we listed in 2017 was that it would make us more visible to our market and it would make us more credible with potential vendors. I think that's been proved out very strongly, and I think that may well be the case if we were listed in the US or the UK or potentially Toronto. We think we could attract other vendor firms more easily, and it would be easier to bank, it would be easier to do virtually anything. So that's certainly something we're continuing. In terms of dividend policy, it's been put to me by our best shareholders and investors forever. Hey, Brett, it'd be much better if you stopped paying dividends and reinvested it, an ROE of 38%. We think that's obvious, but I've paid myself, I think, an average salary of about $240,000 a year over 17 years. And so I have made no secret that I do live off my dividends. And I also think it's a fair partnership that if the internal partners are getting a cash dividend, that the external partners get a monthly cash dividend. That was always the theory. There is much more interest from our shareholder base for us to do more, and it would be easier to do more and much more capital efficient rather than raising equity, diluting shareholders through an expensive capital raise, to simply use the internal capital being generated to grow the group. And we think that we could probably very materially grow the group if that capital was available. So we are seriously looking at how to make that capital available in an intelligent way. A delist go private has been put to us by a number of groups. The rationale of it, we're going to investigate. I want our quality shareholders to share in the long-term compounding opportunity that we think we can provide our investing partners, and we don't want anyone to not be able to participate in that over the next 30 years. It has been always my vision to build the business publicly. We think that there's very strong reasons to be public, to be visible, to be a really credible counterparty, and an obvious permanent capital Buffett style acquirer as an alternative to private equity. So it is certainly my and so yeah, in consideration, no, and no decision to be made, but obviously we will brief people as we go. Hello, Brett and team. You recently hinted at the possibility of suspending dividends. What do you use process further acquisition growth of the business? Can you provide some clarification? Hopefully I'll provide a little bit, but look, we do get asked, there's evidence here often around that. We think that there's more opportunity in the capital that we have available to us, and we are thinking about innovative ways to do that. We could certainly issue a bond to do that. We could do all sorts of interesting things, and we're getting some, I must say, first class and really world class advice on the options around that. And we'll keep everyone advised as we're advised as we go along. Further question, would a delist or go private potentially change the ownership or voting structure? Yes, it may well potentially change the ownership and voting structure. And I guess that's all I could say to that at the moment, because I don't have any more information than that. On dividends, given Australians is likely to be a decent proportion of total, or at least the next few years, with special dividends being applied from time to time. Yes, that's a good observation. To reduce the level of franking credits, retained earnings, there'd be a clean-up of the balance sheet for sure. And or our franking credits are non-issue. Um, Certainly, long-term franking credits are a non-issue. Our best shareholders are global investors. They're outside Australia. They don't get the benefit of franking credits. We haven't had, uh, we had Australian institutional investors at the IPO who got a pop and exited. And so our best shareholders are global, high-quality, long-term value investors. And so franking credits are not particularly relevant. The value of a franking credit versus a 38% ROE is kind of minuscule. So we're just trying to think about long term what's in the best interest of the group, and ultimately we wanted to be the Berkshire of accounting. So we think trying to get into a position where we can do what Warren does. That's always been my long term agenda. Hi, great result. Could you clarify how you calculate the intrinsic value of KPG? I have previously published that and previously said that, the first book I ever read on the stock market was Of Common Stocks and Uncommon Profits by Philip Fisher, which led me to Robert Hagstrom's book, The Warren Buffett Way. In the back of the first edition of that book, he was bold enough to publish a two-stage dividend discount model that really asks you to make two decisions. What do you think, or three decisions? What do you think the 10-year stage growth of the business can be? What do you think the terminal stage growth of the business can be? And what do you think the appropriate discount rate is? So we think the appropriate discount rate for us, so for me as an investor in Kelly Partners that has control, is in my circle of confidence, is buying the same type of business over and over again. For me, the appropriate discount rate is the weighted average cost of capital of the business. It's always been my agenda based on creating shareholder value by Alfred Rappaport that I read in 1994, 5, 6, somewhere there, 7, 6. We're seeking to get a return that's way in excess of our weighted cost of capital to create economic value. So that's the way I think about my discount rate. You can think about your discount rate however you like. And the way we have always talked about our growth rate is 5% organic, 5% acquired, but we've got a 30% CAGR. So you might think that, I'm going to publicly say 5 and 5, which is 10, and we've delivered 31% CAGR for 17 years. So the number's somewhere between 10 and 30. You can make your own choice about that. And there's probably more 100-year-old accounting firms than there are 100-year-old businesses in any other industry. So we think that the continuing prospects of the business of this nature run prudently is probably some number of years beyond 10 and terminal. So that should get you to a number that is different to today's share price. And that's, I guess, all I can say. But I'm often asked, why don't you do more buybacks? A take private is the ultimate buyback. And if the business continues to trade at the levels it's trading, then I'll be very tempted to buy a lot of that business and partner with shareholders that want to be long-term in the business in that exercise. That's not new shareholders. That would be existing shareholders as well as potential new capital providers. Brett, appreciate you looking at the very long term and thinking about the group's future. That was surely would come with a view of what you think the key risk challenges and disruptions would be over the next 30 years. Can you share your thinking around the same? It's a great question. I'm often asked, what are the potential technology impacts of what you do? I have seen our industry over the last 30 years. I've been at this since I was 18. I'm 48. I've been doing this for 30 years. I've been focused on this industry, and I've seen radical change in the industry. I expect there'll be radical change over the next 30 years. Let's start with the investment thesis. Governments of left and right are going to tax more, not less. There's one thing politicians love, and that's taxing people. So they're going to tax more. Multinationals seem to get a free pass. Individuals that are poor don't pay tax. And so it's really just onshore private business owners with complex affairs that really need world-class advice. We know that that's where we positioned the group for 17 years to excel. We don't believe any technology can adequately deal with the complexities that we find within those groups. We're very, very, very confident about that. And we know that those people are going to need strong representation around their tax obligations for certainly the 30-year future. Now, most people know that I admire the world's best investors. Many of them have said, if you can't see what the world looks like in 20 years, you're taking on more risks than you might want to take on. I can see over the next 20 years for certain that governments of all stripes will look to take more money off people that work. I also see a lack of respect for people that risk their capital and build a business. And I don't see that changing. And so with the involvement of digital tools from government around surveillance and carry on, I expect that people are going to need more advice, not less. With a rising level of soft left authoritarianism, the key themes of, how do you enforce your rules is you need more lawyers, you need more accountants, and you need more soldiers. So they're quite good places to invest, even if you don't respect, some of the political moods of the world. So we're pretty confident that there's a future there. And without calling AI out in particular, I see AI as another transformative technology in a long list of transformative technologies that we've harnessed and utilized over the last 30 years to the benefit of the client. Final comment on that really is that if you're just paranoid about your client and how to make your client better off, that's kind of helpful because only the paranoid survive. We're paranoid, so that's helpful. Next question, given you're now based in the US and your significant shareholdings are franked credits are no longer of use to you personally, without commenting on my personal tax affairs, I'm an Australian tax resident. I like a franking credit too, but I ultimately want to be with Berkshire Hathaway of the accounting industry or the Constellation software. Wherever we can find the best use of that capital, we'll use it in the most intelligent way. I wanted to pay monthly dividends so that I could show people the cash flow strength of the business and get people confident with exactly how a dollar flows through our business. I think that we've attracted a high quality group of shareholders now that can really understand the nature of our business and the way a dollar flows through the P&L, the way our balance sheet works, and frankly, the awesome returns on capital that we can, I think, continually deliver to shareholders over a period of time. And so the use of those franking credits and those dividends, we've never run the business. We run the business. We don't run the business for a particular financial or tax situation. We're trying to compound the capital efficiently over a very long period of time. So we'll just continue with that mindset and try and find the best way to do that. And I think ultimately that will create the most value for shareholders, and then they can make arrangements to access that value in the most intelligent way. And hopefully that accords with the mindset of most shareholders. Are you seeing accountants looking for employment with Kelly Partners from the likes of PwC, KPG, etc.? Really interesting. Just to comment on the employment market, 12 months ago, KPMG were phoning our offices, offering our people a 30% pay rise without an interview. That has completely stopped. The market has changed materially around talent. We've been through the last 2 years, certainly 6 months ago, I think it stopped, but the most challenging talent times I've ever seen in the industry over the last couple of years. We've done really incredibly well. We've got great people that share our mission and values, which is the differentiator when it comes to attracting the best people. We think things get a lot better over the next 2 years. And so we're not looking for people from big four firms as a typical starting point as to where we look for our people, because we're not sure that those firms traditionally have looked for people that share our mission and values. But we're looking for the top 2.5% of people that share our mission and values, and we do think that there's probably some of them coming out of all sorts of firms. And so we'll continue to look to add talent to the business. There's, every time we can find it, every time it presents itself. What would happen? That's a great question. I always get this question. So I'm going to tell you a story. I went to the Berkshire meeting this week of this year, and I loved when Warren got up and pre the meeting, they played this video of every time he'd been asked about his succession for about 50 years. I hope to one day be in that position, so touch wood. But look, we did the board meeting yesterday. The board has an explicit directive understanding and has undertaken a position that in the event that I am unable to do what I do currently for the business, there would be two people who've been nominated in the business to be co-CEOs of the group. They've had the training continually for me, both of them, for more than 12 years. They're very close to me and the other partners. They would be accepted by those partners as the leaders of our group, and they've got clear directives on how, in our view as a board and me as a founder, the business should be led in the absence of me. Every partnership agreement has a documented succession protocol in place and has had for many, many years as to what would happen in the event of me not continuing in my role for whatever reason. And I see that and I think evidenced by my level of investment in the group, no particular risk to that. Now, I am spending 75% of my time in the US as of January. I hope people can see that reflects my confidence in my partners. I do not have employees as owners in this group, unlike the big four firms where partners are effectively glorified employees. I have partner owner drivers in our pod model who are genuine owners of the business and have acted as owners of and drivers of this business for many, many years. I feel very passionate about anyone ascribing contribution or influence from me that doesn't take due account of the contribution of our genuinely sensational and committed partner owner drivers in these businesses. They own four businesses. They own nearly 10% of the listed stock. They many of them invested in our equity fund. Many of them have bought buildings in partnership with us that the businesses trade from. Frankly, all of these people have the majority of their net worth invested in our businesses, and they are, to a person, exceptional people. We get continually more and more businesses joining the group because when they call me, and Kenny, I say, look, if you like what you hear and we can get the rubrics of the deal together and you're happy with that, please just meet our partners. And if you like them and you like what you hear from them, then join the group. And if you don't, then please don't. It's our partners that are running this business. And I'm simply under those partners with our services team, lifting them up and trying to make them better off, asking them to make our people better off so that they can make the clients better off and make a strong impact contribution on the community. I'm incredibly proud of these people, and I think that they should be accorded due respect for the contribution that they make. What's the impact of rising rates on your acquisition model? There is no impact of rising rates. The first deal that I did was at 11.1%. We haven't seen interest rates touch that level yet. I don't really mind if they do. If we can push out 30, 32, 35% from the business and we can finance it at less than 11%, I'll be very pleased. Can I still use historical levels of gearing? Can we? Yes. Is it harder to make acquisitions? No. Remember to look left when crossing the street in LA? Yes. Thank you for that. Do you anticipate to cease to be an Australian tax resident? That was a subject of a meeting this morning and is a subject of ongoing discussion. I don't have that advice at this point because I don't have a clear strategic direction for the way to maximise the value of the group. In the FY23 call, you referred to developments in progress to create a marketplace of customer groups. Any further insight? Yeah, we've built a great piece of technology. I now have a team member that worked with us 5 years ago, spent 5 years working at Net Wealth and I think Colonial First State on their app. went off and educated himself in CX design. He's come back here and is working with our in-house software developer to build out what we've called our Kelly Partners Passport. And the idea of the passport is that it will give people access to the full value of the group. A very strong part of that value is the incredible relationships that we've built across the group. So it will ultimately form part of that offer that we can build a marketplace of our clients to share and advance education and services and build that, essentially into a SaaS based business that charges a monthly fee to access more and more value that I think we can add to the client base and that they can add to each other. So, I don't want to put any projections on the dollars that might come from that, but I don't have any doubt that where we build a community of trust, where we do the right thing by our clients and friends and partners, then there's more value long term in that behaviour than I think most people appreciate. I guess I can't see any more questions, but if there's any more questions, have a look here. There's another question. How do we fix Count Plus? It's a great question. Look, I never comment on these other businesses. What I would say is that I get often asked, what is the moat around Kelly Partners? And I guess one of the ways I've come to explain this over the last 6 months is that if you think about a lord in his tower and you think about what's actually involved in building a moat around a castle, somebody has to go out and dig that moat. They need to get, a shovel and start digging. And digging, the foundations of anything, a moat or a castle or any type of business, is dark, smelly work where you don't get any pats on the back. No one notices because you're below ground level and you're just digging. I did that for many, many, many years. And you need to have the courage of your convictions to do that and do that continually. But the real secret is that you have to be able to attract other people that share that mission and believe in that mission and want to dig that moat and want to make it, build it properly, and want to then put the water in it, and then chuck some crocodiles in it, and get the bridge right and make it all work. You've got to attend constantly to the maintenance of that moat. I genuinely believe that when people consider what's the moat around a business, people continually fail to ascribe enough value to how important the shared mission and values are of the people that you need, no matter whether it's a technology business or any other business. It takes a unbelievably talented and committed group of people to put their own self-interest aside while they dig a moat and they do it properly, and then they continually to stand over it and protect it and make it a thing. So, where I see any business struggling, I typically believe it's that the foundational values of the business aren't deep enough, aren't universal enough, and aren't addressing a genuine human need with essentially benevolence towards people in the business and the clients and the community to really want to make other people better off, rather than simply being there, to get some short-term return for themselves. Sounds very zen, but if you think hard about, hey, you want to build a dig hole, dig a big moat around your house today, ask yourself how many of your friends would be prepared to come and get a shovel and spend the next 6 months to the exclusion of everything else, potentially under fire, if somebody shooting arrows at them, digging that moat. And if you can't put that group of people together, you're unlikely to build much. So you do need, and to me, the analysis that I've been able to form is that people join people who have a mission and values that resonate with them and that will sustain them when things get hard, because things always get hard at different times. Hey, have you considered partnering with other firms from non-accounting areas to share similar world-class services? We think that there's an opportunity in the business to appoint a partnership executive to build quality partnerships. Absolutely. We believe that's part of the part of the opportunity set that exists within the business. Not been the best use of our restricted capital in the short term, but we believe that that's best done digitally as we start to pull our community of clients together into a digital first relationship. We'll be able to build more of these partnerships, and we think that there's significant value involved in doing that, and frankly, it would reflect the care that we have for those clients to make that happen. So we intend to do that. Well, it is 10:53. We have 7 minutes allocated, but I'm prepared to make whatever time people would like to answer further questions. Going once. Look, I did get some. I'll just answer a few questions that were emailed to me by shareholders that I haven't had the chance to answer, but I'll share some of them here. Can you please elaborate on how central services and IP fees are allocated beyond minimum viable investments into back office and business development functions, in particular, specifically about the brand, digital, and people investments? Guys, what we get 9% from the businesses, 6.5% for services, 2.5% for IP. We share with you that we intelligently invest that under the businesses to really strengthen the businesses and give them a stronger, more competitive position, so that partners have between 25 and 40% more time to be great accountants to their people, their clients, and communities. We deliberately have taken a position not to share much more than that, because we don't believe that it's in the shareholders' interest for us to share much more of the good stuff that we understand. Number two, can you please elaborate on a comment you made during an interview on the Investment with Tom comment about never selling a significant stake in the business, but looking to get, at some point I'll try to get better set up, which I think will allow me to lead the business in a different way. I'm writing an article at the moment. I'm investigating Warren Buffett's personal financial position. In 1956, he had $160,000. He went back to Omaha, bought a house for $31,000, and he left that $130,000, from what I can discover, in his own personal portfolio that now represents over $1 billion and pays him between $40 and $60 million of dividends a year. I can't get much more information than that, but I'm working to do that. What that has meant is that he's never needed to look to Berkshire to pay him anything in particular. He's been able to run low salary, no dividends, and just sit there acquiring assets. That's the position I ultimately seek to put myself in, and I think that would allow us to play a more expansive game and build a much more significant business over time. Number three, I can't answer. You've spoken about the very important competitive advantage KPG has developed in Australia, because for 17 years you've been building a trusted reputation as a buyer of choice. What are the key factors that give you confidence that KPG can succeed in other geographies at a comparable level to Australia when this advantage is non-existent? That's a great question. What I would say is that we have the position we have in Australia because 17 years ago we started contacting firms in a consistent way, and we just kept doing it metronome-like for 17 years. We believe in order to establish that position in the US and UK, we just need to be contacting firms for the next 17 years. So we don't think that we can create 17 years of value in 17 minutes, but we do believe that we're starting at a much higher level in approaching those markets than we did here. And the inbound interest definitely demonstrates that. So we don't believe that we have a particular advantage in those markets, but we do believe that with consistent effort over a long period of time, we can certainly do in those markets what we've done here. Again, we're sort of not in a rush to do anything silly there, but we believe that if we don't start, we're not going to actually get that done any faster way by not starting. So it's simply a matter of starting. In relation to the 5 stages of decline by Jim Collins, have you implemented specific organisational and personal feedback mechanisms and or guardrails to ensure that we don't wander into hubris born of success and possibly an undisciplined pursuit of more? Absolutely. I hope that people can see that we are staying within our circle of competence, doing what we've always done. We'll seek to enter the US market in LA with a small acquisition of less than $10 million that is exactly the same drivers for the transaction and ultimate partnership, and on the same structure and same terms as we do here. So we are certainly not mindlessly looking for more. Frankly, we're not looking for more really at all, ever. We're simply just trying to do a world-class job of what we're doing and partner with people that want to partner with us. There's a question, what's the parent entity doing to improve debtor days? I think debtor days at 47 days.
We'll reduce to 42.
Yeah, 46 days and then 42 days. I think those numbers are pretty fantastic on a large number. We run genuine discipline and communications in a very unique way with the firm. So we don't really want to share with other people who would love to know how we do that. But I hope that people consider 42 days a pretty good number on a large number. And importantly, nobody would consider the economic situation better today than it was 12 months ago. And by taking our debtor days from 46 days to 42 days, we've achieved about a 10% reduction in those days in a more difficult economy. So we're getting better and better at that. Apologies if you've already answered, but how will a potential privatisation be beneficial to long-term shareholders? It's a great question. I don't know the answer to that, and so we'll do a strategic review to try and understand that. I think the longest-term shareholder at the moment is me. I've been in there for 17 years, and I certainly want to continue to share the value that we're creating with anyone that shares that mindset. Has the business achieved any price rises recently? Have you experienced margin pressure aside from investments made? No, we haven't. Look, the market for accountants is very tight. And so if you've got great people, you can price them at an appropriate rate. Now, sometimes accountants are a little bit reticent to charge really what they're worth. We've overcome that largely with our partners and continue to try and build their confidence to charge what they're worth. As the number of accountants is constricted more and more over the next 5 years, I expect that it's going to cost clients right across the economy a lot more to deal with their accountants, and the accountants will have much more pricing power than they've had in the last 30 years. I'm pretty confident about that. There are reports, I think I've read a Wall Street Journal article about listed companies struggling to get their audits done on time because the firms are struggling to get the people to do the work. And so the only answer to that is that the industry needs to become more attractive for talent, and that means it's going to have to pay people more, which means it is going to have to put its prices up, and people are just going to have to get used to that. So we'll see how that goes. Question for Kenny: how do you describe the challenges of financially integrating partnerships, joining KPG recently, and how would you prepare for the growing complexity that will come with group growing bigger and across jurisdictions?
Yeah, thanks for that question. Great question. Obviously, we're consistently looking for technology to do that. But I think, as you can see, this year we've opened the Mumbai office, both of which operates in different markets and with different currencies. And, we still have not experienced any problems with managing all those different financial complexities. And I think the ability to put these results out, basically, we could have put these out on the 1st of August, shows that we haven't yet encountered any challenges in integrating these any partnership firms or other jurisdictions into our platform and producing those financials that's required. Understand there will be challenges. We are constantly looking at technologies to allow us to better integrate all the financials of our firms. And I still think that we're managing quite well in that we're still able to produce the results in basically record time.
It's quite interesting, probably worth mentioning that we've had Ken's team gone for 8 years now.
Yeah.
There's 10 people.
Yes, 10 people.
So they're here in Sydney at the moment for our awards dinner tonight, which is great. And Ken's built a really tremendous office there with great people who are very, very committed to the group. They worked every Saturday in July without complaint or comment. Frankly, they wanted to get the results done so that we could get on with the rest of the year. We've got an uncommon level of commitment from our teams right across the business because they do genuinely share in the mission and values of our group. What I would say is that we have run that Hong Kong office for 8 years. I've had a number of people say to me, "Hey, Brett, isn't going to the US really scary and different?" And I'm like, well, Hong Kong's a lot more different to Australia than the US is different to Australia. And we are running an operating business out of the Hong Kong office that does outsource CFO work for a number of our franchise clients. It's been very successful. And we've been doing that for nearly 8 years. So, commencing an office in Hong Kong on short notice, operating a different jurisdiction, and running a team where I used to meet with Ken on a phone on a dodgy Apple. What was it called? No, what was it? Like the Apple video phone call. FaceTime. That's a lot different to the level of interaction now that we had with Zoom even 2 years ago. And now, frankly, Microsoft Teams is a phenomenal product that's working incredibly well for us across our Microsoft 365 installation across the group. It makes us feel very close to each other and what we're trying to do. I just made the call and I said to Ken, "Hey, you're going to be in Sydney this week. I'm going to be in Sydney. Why don't we just do the results while we're actually sitting in the same room and bring your team down?" And so rather than do it the other day, we'll do it today, just because we thought that'd be more fun and better for everyone. But yeah, look, we've got some history with operating in Hong Kong. It was always my view that Hong Kong could be a stepping off point to the rest of the world. And interestingly, what we've done is bringing really interesting opportunities to us, opportunities to partner with people in different jurisdictions to help them fix their things and contribute to what they're doing. I think there's a bunch of exciting opportunities that just would not even have crossed our paths or crossed our mind or have been presented to us if we hadn't changed the posture of the group and said to people that, hey, we're prepared to help businesses of this nature, in the US, in the UK, if they share our mission values and think that we can be a valuable partner with them. So that's what we had to share today. We hope that people have found that very interesting, and we are quietly confident and very determined to continue to prosecute the business case and build a business that can make a very positive impact. And I really wanted to thank all of our quality shareholders for their commitment and partnership in the business. We don't take any partner for granted in our business. Any of our team, our equity partners, our shareholders, our clients, or the communities that we are running these businesses in. And we believe that if we operate consistently with our mission and values and the way our business model for a long time, with real intensity and a relentless focus, then the future remains very bright for the business, frankly, increasingly so. And with that, if there's no more questions, there's just one more. Obviously, you're juggling many balls at the same time. It's going to get trickier as KPG grows. How do you focus on strengthening your personal core as the most key man? Look, I continually try to make myself less key man. I think that it's overstated. I'm a very driven, committed person that has ideas and insights that experience that I'm not sure many other people have. However, I shared that outlook, that mission, that values, those insights with many of my people for a long time, and I'm incredibly proud and very confident in the quality of those people. I really couldn't do more to make myself less within the business and the business less dependent on myself. And, short of taking a 5-year holiday. And so you should be very confident that, the number one role of a CEO is to be the chief risk manager. I share Monash Pabrai's wonderful Dando mindset of, heads we win, tails we don't lose. The number one rule for me is don't lose. And I mean by that, not just don't lose money, don't lose reputation, don't do anything that puts our business or our relationships at risk, or your health, or your values. Take no risk, inform yourself better, create asymmetrical opportunities, and relentlessly focus on that. So with that last comment, I'd love to thank everyone for their continuing involvement with the business. And feel free to be in touch with Ken and I and ask any questions. We are around and happy and eager to answer any question that occurs to anyone. Do the analysis of the numbers. We frankly have benefited, and the business has benefited from the commitment of our shareholders to looking at our business and asking us intelligent questions that helps us to reflect and think through better how to operate and continue to grow the business. And with that, I'd love to thank everyone, thank my team for organising today. There's a bunch of technology happening here to keep everyone together. And I just I'm relieved that that's all worked out. And as I love to say, have a great day.